Have you ever chased a stock that was breaking out or sold out of a position way too soon? Well, it's probably not your strategy that is at fault. It's your mindset. So this is going to be the only trading psychology video that you'll need to fix those mistakes and start trading like a pro. So I've done all those mistakes as well. Sold too soon, chased breakouts, and unfortunately, that led to a lot of losses. However, we can fix those mistakes. So in this video, we're going to cover 5 emotional traps that are killing your trades, and we're going to offer some simple fixes as well. If you like what you see in this video, you can check out the first link in the description below. So let's jump right into it and look at this chart and this table. I'm going to run through the emotions, the mistakes, the root causes, and then we're also going to find a fix. So the first major emotional trap is greed. And the mistake that many beginners make is they chase breakout. So they're chasing a stock that has broken out. And the root cause is that you're focusing on profits over process. So we're going to cover that and talk about a fix for that. Secondly, fear. That's another big emotion that is killing your trades. So selling early is a common mistake for people suffering from this. And you're sort of tying your self-worth to losses. So that's the root cause of fear. Next, we have anger. So people might revenge trade. So you might believe that the market should be fair, when in reality, they are not always. Overconfidence is another big emotion and a problem. So you might ignore your stops. You might ignore the signals. And this could come from this illusion that you think you can control the market. And then lastly, we have weak discipline. So you just abandon any strategy that you're following. And the reason is that you're lacking systems in order to stay consistent with your trading. So let's jump into these in more detail. And we're going to also outline some fixes. So greed's really common. The fear of missing out, this pushes traders to, chase soaring stocks at breakout peaks, and it leads to losses when prices reverse. So I've done this in the past. I think many beginners do. When a stock runs up to an all-time high position, everyone buys, and then that is sometimes a resistance zone, and the stock just naturally pulls back. People buy high, they panic when the stock retraces, and they sell and they lose. And it happens over and over if you don't understand technical analysis. And the trap here is that you think that you got to get in now. So you see a stock breaking out, and you sort of have a short-term mindset where you want to get in because you don't want to miss that 5% or that 10% pop. So you're thinking that you need to get in now, and you buy at peaks only to get trapped when prices reverse. So it's a very, very common thing that happens to beginners. And the cause is that we are focusing on quick profits instead of a long-term plan. So we sort of have a scarcity mindset as opposed to knowing what your strategy is, knowing your long-term goal with trading, and then you won't have to worry about these quick wins and these quick profits. There's also something called anchoring bias. So there's a lot of things associated with these psychological traits called cognitive biases. These are just sort of errors in thinking. So if we look at anchoring bias, and I'll just reference it here. Anchoring bias, it's a error in thinking when traders sort of fixate on initial information. So a stock's recent price surge, and then you base the decisions on that, ignoring any new evidence. So what this does, it makes you believe that a stock will continue climbing because you're anchored to its recent high, leading to impulsive buys at peak prices. So a scarcity mindset, an anchoring bias where you're just focused on the recent rise of that stock, doesn't allow you to make proper trading decisions. And then you focus on getting in now and getting in quickly just for some quick wins. So that's the whole thing with greed. And one of the easy ways to fix this might be to cap your trades. So depending on what strategy you're using, you might want to cap some trades to just a few trades per week or less, depending on the strategy that you're using. And then just realign your focus to have a disciplined trading focus that focuses on compounding gains over time, as opposed to just trying to lock in some really quick wins. Okay, so that's greed. Next big one is fear. So fear drives traders to panic sell at support or to cut winners early, missing out on a lot of potential profits. Selling early is actually a really, really bad feeling. Fear from doing that, or from panic selling when you buy a stock at the wrong place and it retraces, it really leaves you not feeling good. It's sort of like a gut punch in your stomach, making you really doubt your trades. You doubt your trades when things dip, if you don't understand the strategy that you're focused on, and then selling too soon, getting too scared of that, and then the stock takes off. It's really, really a bad feeling. So that's the trap that fear does. And it creates you to sell at the wrong time. So you don't want to sell at support, and you don't want to cut winners short based on fear. And the root cause here is that you're tying your self-worth to the losses, and you're worried about not looking smart if a trade fails. So you're tying yourself to the outcome of your trades, and you really need to try to not care so much. I know that's easier said than done, but the quick fix for fear would just be to journal every trade. So if you make a trade and you sell too quickly, or you panic sell at support, journal your trades and analyze them and think, was this out of fear, or was this a logical trade? And over time of journaling these trades like this, you're going to build more confidence, and you're going to get better at really understanding when fear is creeping into your trades. And you can probably work on halting it and not making these panic sells or selling stocks too early. So journaling your trades and explaining why you made them is a great way to fix the fear that's creeping into your trading. Okay, next is anger. So anger after a loss fuels revenge trading, causing impulsive, high-risk trades to sort of win back your money. Now, on a personal note, I have not experienced any revenge trading because the strategy that I'm using, it's got such a high win rate, and it's not day trading in and out. So I rarely have to worry about this because we're in a bull market. We're buying bullish stocks at support. We rarely lose any trades. It's a really simple, low stress strategy, but I've certainly experienced this, and you may have as well. If you just go and hit up the casino, you might be, at the roulette table, and it's been black like 5-6 times in a row, and you're thinking it has to be red next, and you place a bet and you lose, and then you double down and you revenge bet. So it happens in different scenarios, maybe not solely in trading, but basically the trap is that anger flares up after a loss, and you think that the market's sort of cheating you. So, how could on the roulette table it be black 5 times in a row? The next one has to be red. And then you make that bet, you lose, and you just think that the casino is out to get you. So that's the trap. And the mistake is that you're jumping back into trades in order to win back your losses. And this is going to lead to bad trading, over trading, and just not making sound trades. And the root cause for this is that you believe that the market should be fair, which fuels impulsive trades. And you have something called entitlement bias. So if we look at what entitlement bias is, it's another cognitive bias, so another error in thinking, where you believe that you deserve certain outcomes or rewards because of your effort, your status, or your perceived fairness. So in trading, it manifests as thinking that the market owes you profits because you did a lot of research, you followed a strategy, and it leads to emotional reactions when these losses occur. So entitlement bias, you're thinking the market owes you something, you lose out on a trade, and then you get angry. So one fix for this would be to just take a break after a loss. So if you're day trading, if you're trading in and out a lot, then you can maybe take a 10-minute break, a 5-minute break, or whatever. If you're trading less, like I do with my strategy, it might just mean I don't trade for a couple of days. If I've been really angry with something, then I maybe just take a week off. And with the strategy that I focus on, my positions are fine. I don't need to worry about them. But it allows you to walk away, take a deep breath, sort of reset, whether that's a short amount of a break or a longer break. So just take some time off. It's going to really help with anger that's creeping into your trades. Okay, next we have overconfidence. So overconfidence after wins it makes traders ignore a stop loss that you might have in place, or it just exposes them to significant market risks, like just ignoring other signals. If you're overconfident, you're not going to pay attention to certain things. So the trap is that it makes you feel like you're a genius after a win. And, it's easy to make a few wins as you're a beginner trader. If you buy a stock, it's sort of like it's either goes up or it goes down. So you might get into this area where you are very overconfident if you get some beginner's luck happening when you're first starting to trade. And the mistake is that you're going to start ignoring stop losses or just ignoring signals in your strategy, and you will think that you don't need them. And that's going to lead to future mistakes and losses. And the main cause here is that you have this illusion that you can control the market, ignoring the risks that come up. And this also brings up this thing called the Dunning-Kruger effect. And basically what this is, it's another cognitive bias, so an error in thinking, where people with limited knowledge or skill in a specific area, they overestimate their abilities, thinking that they're better than they actually are. So in trading, this often happens to beginners who after a few wins, they feel like the market is something that they have mastered, they're experts, and they start making risky moves without fully understanding the confidence, fully understanding the consequences. So that's the Dunning-Kruger effect can kick in with this overconfident emotion. And the main fix is that you want to write a list of your rules and stick to them. So make a sticky note, maybe an affirmation before you start trading, and say it before your session. So with the strategy that I am trading with, the main rule, there's just one main rule. It's only buy at support. Be careful around resistance. So if the stock is not in a support zone, we just don't buy it. We move on. We wait for other opportunities. We let the market come to us. If it's not in support, do not make the trade. This is going to help us avoid any emotion of overconfidence that creeps in, because if it's not based on our entry rules, we just do not make it. And we just have way, way less losses this way. And then finally, we have weak discipline. So weak discipline leads traders to abandon strategies, trade impulsively, and this was going to lead to losses, obviously. So basically, weak discipline feels like I'm going to skip my rules just this once. And unfortunately, that's going to lead to losses. And it's just not something you want to continue to do if you want to become a, full-time trader, a profitable trader. All the profitable traders out there that are doing well, they don't have weak discipline. They have extremely high levels of discipline. And the mistake that you're going to make is you're going to ditch your strategy. You're going to trade impulsively. You're going to chase quick wins. And again, over the long term, this is not going to work out for you. And one of the root causes is that you're just lacking a system to stay consistent. So you're letting fatigue win, and you have also present bias. So you want instant reward. So this day and age, I think many people have present bias. We want that instant gratification. We want the quick wins. We don't want to always put in the work, but that's not going to be good for trading. And sometimes if you don't have a strategy that really has clear rules, has good points on entry, exits, and position sizes, then if that's not clear, in your strategy, then it's going to be easier for you to get tired and just kind of not stay consistent and disciplined with your strategy. So a big fix for this is to have a strategy that offers some sort of pre-trade checklist. So, before you make a trade, run through a checklist. Does it meet, some of these criteria? Now, if not, then you just don't put on the trade. And again, it sort of goes back to our last point about having a rule, a set of rules that you follow. If the trade doesn't meet that, if it's not within the checklist, then you just don't make the trade. And this is going to help you make more consistent trades and profitable trades over time. So if we did a quick review here of the 5 emotions that are killing our trades, firstly, greed. The easy fix for this is going to be cap your trades. So over trading, fear of missing out, you're going to do more impulsive trades like that. It's something you want to strongly avoid. So cap your trades, whether it's if you're day trading, you probably want to, trade if, quite less during the day. If you're making less trades, just, take a week off from trading or just trade once a week, depending on what strategy you are using. Fear, journal it. So, if you're selling too early because you're scared, or you're buying because you're scared, or whatever you're doing, after you trade, journal it and think, was that a logical decision? Was that a good entry? Was that a good exit? And the more you journal, the more you go over your trades, you're going to really learn from your mistakes, and you're going to be able to sort of knock out any fear that creeps in to future trading sessions. Anger. If you get angry, take a break, whether it's for the day or for longer. Just step away from the trading for that time. Overconfidence. I use some cues. So, if you're overconfident, remember to have a sticky note, follow your rules, have a strategy that gives you clear rules, so you don't make trades just because you are overconfident in the moment. If you have weak discipline, get a checklist, get a pre-checklist for making trades. Find a strategy that's going to allow you to stay disciplined based on some easy checklists and some easy rules. So those are the main things. For more information, if you want to learn more about the strategy that I'm trading with, which really allows me to eliminate any anger in my trades, I have a set of rules that we follow with this strategy. So we aren't overconfident because we just don't make entries unless we are in a specific support zone. You can learn more about that in the first link of the description. So I hope that you found this video useful. Some of these things you will experience if you're just a beginner. If you start paper trading, I think a lot of these emotions are going to creep in. The more you are aware of them, some of the fixes that we went over today in this video are going to help. And I hope that when these pop up in your trading, you can be aware of them and you can fix the issue moving forward. So thanks so much for watching. On the screen right now, I will also put up another video that I think that you might find useful.